Affordability has hit its lowest point in recent history. People struggle to afford both buying and renting homes, reminiscent of the real estate market's historical boom and bust cycles. This year might witness another crash, signaling tough times ahead. The housing market's current state is unprecedented since the 1980s, marked by rapidly rising interest rates and stagnant housing prices. As experts sound the alarm on the housing market's fragility, it's time to confront the harsh truths and prepare for what lies ahead. Please make sure to subscribe and leave us a like below the video. In 2024, the housing market remains shocking, with various factors driving its instability. Rising interest rates, coupled with stagnant housing prices, have led to a frozen market where buyers find it increasingly difficult to secure mortgages and sellers hesitate to sell. Existing home sales are projected to hit their lowest levels since 1995, while pending sales are at historic lows since recording began in 2001. Despite an 18% population increase, homeowners are reluctant to move due to favorable mortgage rates obtained through refinancing. The situation echoes the early 1980s when mortgage rates skyrocketed. However, despite brief setbacks, housing prices generally continue to rise. Today's challenges mirror those of the 1980s, with soaring mortgage rates, high prices, limited supply, and robust pent-up demand creating economic tension. Home builders struggle to keep up with demand, resulting in a significant housing unit deficit nationwide. Looking ahead to 2024, elevated prices driven by pandemic-induced demand during COVID-19 peak exacerbate the situation. Mortgage rates have surged to historic highs, making homeownership increasingly unattainable. Affordability remains a significant concern, with analysts predicting a potential decline in the housing market. The ratio of average sales price to income serves as a basic measure of market valuation, indicating whether the market is over or undervalued. The housing market faces unprecedented challenges in 2024, with affordability, soaring mortgage rates, and limited supply creating economic uncertainty for both buyers and sellers. Today, nationwide, we're grappling with the worst affordability crisis since 1984. According to CNN, a staggering 38.6% of the median household income is now required to cover the monthly payment on the average home purchase. Typically, a home is considered affordable if this figure falls below 30%. However, this threshold is exceeded in 99% of the United States for the average American earning $71,000 annually. Realtor.com further highlights that a yearly income of nearly $110,000 is necessary to qualify for the average home purchase with a 20% down payment, while on the West Coast, this figure jumps to $161,000. Matthew Graham, the chief operating officer at Mortgage News Daily, aptly describes this reality as painful and ugly, resonating with the sentiments of many struggling to navigate the housing market turmoil. During the initial 2 years of the pandemic, the Federal Reserve implemented drastic measures, reducing its benchmark rate to zero and injecting funds into mortgage-backed securities. This led to historically low mortgage rates, fueling a buying frenzy compounded by urban exodus and the rise of remote work. Consequently, home prices surged by an astonishing 40% from pre-pandemic levels. Despite expectations, raising interest rates did not dampen home prices. Unlike previous market trends, the current scenario is marked by both rising rates and a significant shortage of homes, exacerbated by the aftermath of the 2008 Great Recession, which severely impacted home builders. Data from October 2023 reveals a 4.8% increase in home prices for the 9th consecutive month, with existing homes selling at near record highs. The National Association of Realtors reported a 4% rise in median home prices compared to the previous year, marking the 5th consecutive month of year-over-year increases. However, this soaring demand is met with a frustratingly tight market, with the National Association of Realtors reporting a 3.5-month supply of homes in November. Rick Arvello, head of New American Funding, emphasizes that this shortage will prevent any decline in house prices, underscoring the challenging landscape prospective home buyers face. The December 2023 Housing Market Trends report from Realtor.com underscores the impact of high mortgage rates, resulting in a 6.1% increase in the monthly cost of financing a typical home compared to the previous year, after a 20% down payment. This means that buyers today are facing an additional cost of $123 each month compared to those just last December. Housing experts anticipate a market correction, although they don't foresee massive price drops akin to those seen during the Great Recession. Surprisingly, high mortgage rates now surpass high home prices as the primary reason consumers perceive it as a bad time to buy a home, leading to the lowest consumer confidence ever reported. These factors set the stage for potential external influences that could negatively impact the real estate market in 2024. However, this is only scratching the surface. Regarding why housing prices might start to rise again and what actions can be taken, the most crucial factor to consider is falling interest rates. Wells Fargo predicts that home prices will continue appreciating, rising by 2.5% in 2024 and 4.4% in 2025. Similarly, Zillow forecasts a 6.5% increase in home prices by July 2024, and Goldman Sachs agrees, stating that home prices are unlikely to decline from current levels. Who bears the brunt of the current housing market scenario? Potential sellers find themselves in a tough spot. They are hesitant to relinquish their current 3% mortgage rates, fearing the prospect of an 8% rate on a new purchase. Why swap a 3% mortgage at $2,000 monthly for the same mortgage costing $3,300 at today's 7% rate? However, with the belief that interest rates will decrease, research indicates that a 30-year fixed-rate mortgage falling to 5.5% is the tipping point that could prompt more home buyers to enter the market. Additionally, homeowners who are also potential home buyers may view a drop in rates as an opportunity to sell quickly before competition intensifies, potentially leading to a sudden increase in inventory this year. I don't think anybody in my community of mortgage originators would disagree that in many ways, this is worse than the great financial crisis in terms of volume and activity, remarks M&D's Graham. Amidst this uncertainty, experts grapple with predicting when a market might experience a decline in rates. We do hear a chorus of Fed speakers saying they are restrictive and can wait to see how policies filter through to the economy, notes a financial expert. These decisions' ripple effects on everyday lives raise intriguing questions. Consider this alarming fact. Sales of previously owned homes in September 2022 hit their slowest pace since October 2010, as reported by the National Association of Realtors. However, our current housing landscape differs significantly from the foreclosure crisis era. Foreclosures are at a historic low, and homeowners today benefit from high equity due to record low interest rates between 2020 and 2022. Surprisingly, potential buyers find themselves in a tight spot. I think people are anxious, and there's a lot of buyer mentality of we're going to wait and see. So a lot of people just want to sit tight and see what happens, shares Lisa Rich, a real estate agent with Compass in Washington, D.C. Given these uncertainties, how you think this waiting game is affecting both buyers and sellers? Ken H. Johnson, a housing economist at Florida Atlantic University, paints a picture of the housing market being pulled in different directions. He suggests that we might be entering a period where housing prices remain relatively flat across the country. High mortgage rates are exerting downward pressure on prices, while strong demand from new households and a shortage of homes for sale are pushing prices up. For now, these opposing forces seem to be balancing each other out. Although the construction of single-family homes is slowly increasing, it still fails to keep pace with demand. Builder sentiment is declining due to higher rates, yet the new home market remains more active compared to the market for existing homes. On a positive note for housing, apartment rents are finally slowing down, thanks to a record number of new apartments entering the market. With rents cooling off, renters may feel less pressure to buy. However, the demand for rentals is on the rise, driven by slowing inflation and a strong job market, particularly among young adults seeking rental apartments, notes Jay Parsons, chief economist. However, for those looking to transition to larger or smaller homes, the situation becomes tricky. Prices continue to rise due to the supply and demand imbalance, but sellers are becoming more flexible. A buyer might choose to purchase now at higher prices, hoping for a better price later, or they could wait for rates to drop. However, the catch is that when rates do drop, there might be a rush of people wanting to buy, leading to bidding wars. Please make sure to subscribe to the channel for more videos, and give this video a like if you enjoyed. Let us know in the comments what you think. Thank you so much for watching.